September 9, 2010. Real Estate Capital Scoreboard September 2010. Chicago, Illinois, September 9, 2010. The summer season ended with Treasury yields declining, but returning to levels of the previous month. Yet, more lenders returned to the market and the agencies marched forward by offering even lower spreads by 20 basis points or more. Borrowers with high-quality, institutional projects are the winners within today's debt markets. However, a substantial disconnect exists for older projects in secondary markets as borrowers must accept higher pricing, less leverage and recourse. Observations for the month include capitalization rates sliding downward in tandem with lower mortgage rates and increased availability of leverage, up to 75% for many institutional-grade office, retail, industrial and apartment properties. Overall capitalization rates for multi-tenant, commercial properties, for example, office and industrial, are about 50 to 150 basis points lower than the beginning of the year, starting as low as 7.5%. On the other hand, credit-tenant commercial properties with longer-term leases can trade below 7%. Multifamily cap rates often are bid down below 7% for core plus assets and can dip well below 6% for prime quality properties in major markets. Investors bid up sub-performing properties and economic recovery looms on the horizon, particularly true for lodging properties. As has been the case for most of this quarter, rates are at their lowest levels since the 1960s. More banks and life companies re-enter funding landscape as balance sheets are being cleaned up. Expect greater bidding on the right quality assets. According to Jim Postweiler, advisory board member of the Real Estate Capital Institute, a substantial disconnect exists between available product and optimal debt pricing. He notes, funding sources are still selective, but will provide very attractive terms if conservative leverage is sought.